Hey, how's it going, everybody? And before we start, remember to leave a like, subscribe, and hit the notification bell for more. Today, we're going to be talking all about what is an expense ratio. The expense ratio, of course, if you don't know already, is the annual fee that a mutual fund or ETF charges its investors to cover the fund's operating expenses. The fee is expressed as a percentage of the fund's average assets under management, AUM. In simpler terms, it represents how much you pay each year to invest in a fund. Okay? And that covers things like management fees, the cost of portfolio management, including paying fund managers and research teams as well, administrative fees, operation costs like trading fees, legal fees, custodial fees, and accounting, marketing fees, if applicable. Sometimes it's not. Some funds include a portion of it for distribution or advertising costs. Now, you may be asking yourself, how is the expense ratio calculated? The expense ratio is calculated by dividing the fund's annual operating expenses by the average assets under management. So expense ratio equals total annual fund expenses over the average assets under management, AUM. So, for example, if a fund has $100 million in assets and only $1 million in annual expenses, its expense ratio would be 1%, I believe. So in this case, the fund charges an annual fee of 1% of the assets you invested. Yeah, I'm a whiz at math. A whiz. A wizard. So in this case, okay, yeah, we got that. Key points about expense ratios. Effect on returns. The expense ratio is subtracted from the fund's returns before you receive them. For example, if a fund returns 8% for the year, but the expense ratio is 0.5, your net return will be 7.5%. So, types of funds with different expense ratios as well. Actively managed funds, passively managed funds like index funds / ETFs. These funds can track a market index like the S&P 500 and require a lot less management. So they tend to have much lower expense ratios, often around 0.03% to 0.1% for ETFs and index mutual funds. ETFs typically have lower expense ratios than mutual funds because they're passively managed and trade like stocks. Okay. Now you may be asking yourself why it matters. Well, low expense ratios over time, lower fees generally result in better long-term performance, especially if you're investing for decades. The cost of fees compounds, so paying a high expense ratio can significantly eat into your returns. Higher expense ratio. Actively managed funds often come with higher fees because of the cost involved in research, management, and frequent trading. However, these funds may justify their higher costs if they outperform the market consistently. So why should you care? Well, cost impact, fund performance, long-term growth. These are all reasons why you should probably care about expense ratios. And how to minimize the impact of expense ratios is choose a low-cost index fund / ETF, possibly consider long-term. Look beyond the expense ratio as well. And so in conclusion, the expense ratio is a key factor in determining the cost effectiveness of an investor. Lower expense ratios are generally more favorable because they leave you more of your money working for you. However, when choosing a fund, it's important to consider the balance between cost, performance, and your overall investment strategy. That's all I got for you today. Thank you very much.